Imagine waking up one morning to discover that half of your crypto portfolio is frozen, your favorite exchange has halted withdrawals, and your inbox is flooded with legal notices. Across the globe, headlines scream, SEC's new crypto rules shake the industry to its core. Overnight, projects worth billions are put under the microscope. Is this the beginning of the end for crypto as we know it, or the start of something better? Welcome to the most consequential regulatory upheaval the crypto world has ever faced. The U.S. Securities and Exchange Commission's 2025 guidance has just landed, and its ripples are already being felt from Silicon Valley to Singapore. Whether you're a casual investor, a hardcore DeFi developer, or simply crypto curious, what's happening now could decide the fate of digital assets for the next decade. But how did we get here? And why is everyone, regulators, developers, Wall Street giants, so anxious about these new rules? Let's rewind. The hunt to regulate crypto assets isn't new. The SEC, the all-powerful U.S. watchdog, has been wrestling with how digital tokens fit into old-school securities law for years. At the heart of this battle is the infamous Howey test, a legal tool born in 1946, decades before the internet, let alone Bitcoin. The test asks 4 questions. Was there an investment of money? Is there an expectation of profit? Is there a common enterprise? And crucially, do profits rely on the efforts of others? For years, this test has been the hammer in the SEC's toolkit, smashing token projects that stray too close to acting like stocks. Cases like LBRY and Ripple sent shockwaves through the crypto community. In the LBRY case, the court ruled that its token was an unregistered security. In the Ripple saga, institutional sales of XRP were deemed securities, but public sales were not. These decisions left both participants and observers scratching their heads. What exactly counts as a security in the world of blockchain? The lack of clarity was more than a headache. It was an existential threat. Startups faced the nightmare of building products without knowing what legal landmines lay ahead. Investors hesitated, unsure if their tokens would suddenly be outlawed. Even the biggest names in tech, finance, and crypto lobbied for answers. Fast forward to April 10, 2025. The SEC's Division of Corporation Finance releases its sweeping new guidance. The main goal? End the ambiguity once and for all. The guidance promises a clear system for sorting security tokens from non-security tokens. But this isn't just a bureaucratic update. It's a fundamental shift in how the U.S., and by extension the world, will treat digital assets. The old Howey test remains, but it's now turbocharged with new details. The centerpiece of the 2025 guidance is the focus on the reasonable expectation of profit. If buyers grab tokens hoping that a core team or promoter will deliver gains, then, bam, the token is a security. As the SEC clearly states, where entrepreneurial efforts drive price appreciation, token holders effectively invest in a common enterprise. But the SEC didn't stop there. It added a 3-pronged framework to judge every token. First, the initial sale context. Was the token pushed as an investment? Were flashy promises made about its future price? Second, ongoing use. Does the token do something useful on a decentralized network, or is it just a digital lottery ticket? Third, issuer influence. How much control does the founding team keep? Is the project truly decentralized, or does the core group still steer the ship? Tokens that fail this test, such as those with profit-centric marketing, centralized governance, or limited real-world utility, are now squarely in the SEC's crosshairs. Initial coin offerings, profit-sharing tokens, and even some so-called utility tokens that dangle financial carrots are suddenly at risk. For crypto entrepreneurs, this is nothing short of a minefield. A misplaced promise on a website, a poorly worded tweet, or a hidden pre-mine could tip the legal scales and trigger SEC action. But it's not all doom and gloom. The guidance also carves out safe zones. Stablecoins, if they're fully backed and used like digital dollars for payments, not investments, are generally safe. Tokens like Ether, Solana, and Avalanche, which power decentralized networks and are used to pay transaction fees, stand a much better chance of escaping the securities label. The key is decentralization and functionality over profit promises. It sounds simple, but in the real world, almost no project fits neatly into one box. Gray zones abound. So why did the SEC act now? The pressure to regulate crypto has never been higher. In 2024 and early 2025, a perfect storm hit global finance. On the one hand, more companies and even governments began adopting crypto technologies. On the other, scams, rug pulls, and billion-dollar failures grabbed headlines. Investors demanded protections. Regulators feared systemic risk. Enter the SEC's new crypto task force launched in January 2025. Spearheaded by Hester Pierce, known in the industry as Crypto Mom, the task force was designed to break the regulatory stalemate. For the first time, the SEC convened a crypto roundtable, bringing together developers, investors, and skeptics. Public feedback flooded in, pressure mounted from all sides, from Congress, from the industry, and from ordinary investors burned by the latest crypto collapse. In the background, the world watched closely as SEC leadership changed hands. In April 2025, Paul Atkins stepped in as SEC chair, promising a pragmatic, firm, but fair approach. His first order of business? Bringing the ambiguous world of digital assets into the regulatory sunlight. The SEC's move wasn't just about investor protection. It was also a strategic play to expand its regulatory reach, setting the tone not just for the US, but influencing how other nations shape their own crypto laws. In a world where money, assets, and code ignore borders, the SEC's 2025 guidance could become a global template. But cracks quickly appeared. The industry split into camps. On one side, champions of the guidance argued that clear rules would finally unlock institutional investment. With the shadow of ambiguity lifted, said Alison Mangiero of the Crypto Council for Innovation, serious players can finally enter the arena. On the other, critics complained that the SEC was overreaching. Commissioner Caroline Crenshaw warned that parts of the guidance, especially around staking and governance tokens, contradict established court precedents, creating legal uncertainty. Hester Pierce herself called for tailored disclosure frameworks for crypto assets to foster innovation, instead of treating all projects with the same regulatory brush. And what about the developers themselves, the heart of the crypto revolution? Some welcomed clarity, even tough rules. Better to know the boundaries than live in fear. Others saw disaster. Innovation would flee overseas, strangled by legal fees and red tape. A developer from a major US blockchain startup summed it up in a now viral post. It feels like we've been waiting for traffic lights at every intersection. Instead, we got a police checkpoint on every block. Even the big boys on Wall Street weren't sure what to make of it. Would the new guidance unlock a flood of crypto ETFs and institutional products, or would it scare them off for good? Meanwhile, a parallel drama played out in the halls of Congress, where comprehensive crypto legislation, the Lummis-Gillibrand Payment Stablecoin Act, was gaining traction. This law aimed to establish a clear framework for stablecoins, one of the fastest-growing parts of the crypto ecosystem. But could lawmakers move fast enough, or would the SEC's new guidance set the rules by default? All this unfolded as new reporting rules went into effect. Brokers now must file crypto sales on Form 1099-DA. The regulatory net was tightening. Even seemingly minor decisions, like allowing a 20% commodity haircut to help broker-dealers offer crypto ETPs, were shaping the landscape. And at the center of the storm, the fate of staking hung in the balance. Staking, one of the most innovative parts of blockchain tech, where users lock tokens to secure networks, was put under scrutiny. Was staking an investment contract, or just a technical function? The SEC's Division of Corporation Finance hinted that some staking activities might fall outside securities law, but left the details vague. Confusion reigned. One expert, Marcin Kazmierczak of Redstone, noted, SEC's guidance marks a shift from enforcement, but comprehensive crypto regulation is still evolutionary. Amid the confusion and debate, a high-stakes question loomed. Would this new regime suffocate the creative energy of crypto, or finally bring the trust and stability needed for mainstream adoption? The battle lines are drawn. Developers weigh whether to stay in the US or move projects abroad. Innovators debate. Is compliance possible, or will decentralization always clash with the law? Investors scramble, rereading white papers, watching for tokens that might now cross the SEC's red line. As the Crypto Task Force works on its first major report, and as the industry braces for new enforcement actions, one question is on everyone's mind. Will the SEC's 2025 crackdown save crypto from chaos, or kill its revolutionary spirit for good? And as we move deeper into this regulatory drama, the intrigue only grows. What happens if the SEC approves the first Ether staking ETF? Would that trigger a gold rush of institutional money, or unleash new conflicts over decentralization? Will Congress step in with sweeping legislation that changes the game yet again? The answers lie just ahead, as the lines between opportunity and overreach grow ever more blurred. As the dust settles around the SEC's 2025 guidance, the crypto world stands at a crossroads. With the new three-pronged system now in play, focusing on the initial sale context, ongoing use, and issuer influence. The future of crypto in the United States hangs in the balance. So, what's next? Will these sweeping regulations bring the clarity and trust so many have been craving, or will the US become a no-go zone for crypto innovation? Let's fast forward and imagine the landscape a year or two from now. Picture new crypto startups studying the SEC's guidance with a magnifying glass, agonizing over the difference between promoting a token's functional utility and merely hinting at future profits. Lawyers are in high demand, rewriting white papers and marketing materials to avoid even the faintest whiff of investment promises. Established projects are scrambling to prove their decentralization, not just in governance but in how they build, market, and maintain their networks. On the investor front, there's a palpable shift. The days of Wild West ICOs promising 100x returns are fading. Instead, institutional money, once hesitant, is eyeing the market with renewed interest. With clearer rules, we finally know where the line is, says fintech analyst Olivia Brandt. Institutions thrive on certainty, and now the SEC has drawn that line. But not everyone is celebrating. For every startup encouraged by the new clarity, there's another muttering about regulatory overreach. Some developers, especially those on the bleeding edge of DeFi, warn that the guidance could stifle creative new models before they're even born. The story of one prominent developer, known online as @0day, captures this mood. I want to innovate in the open, but if every tweak risks triggering a securities investigation, maybe it's just safer to launch from Singapore. This tension sets the stage for three major possible futures. First, the optimistic scenario. The SEC's guidance acts as a magnet for responsible builders. Projects embrace the detailed rules, institutional capital flows in, and the US becomes the epicenter of safe, scalable blockchain adoption. Imagine Ether staking ETFs hitting the market, drawing billions in new investments overnight. Major companies issue utility and governance tokens with SEC blessing, bringing mainstream respectability to the space. The US regulatory stamp becomes a global gold standard, something teams actively seek rather than avoid. But the pessimistic scenario isn't hard to picture. Developers unwilling to lock horns with regulators quietly move operations overseas. DAOs and DeFi protocols become more secretive, or simply geofence US users out entirely. Crypto's most creative minds build the next wave of innovation in friendlier regulatory climates. The US market stagnates, and consumers are left with watered-down offerings while the real innovation happens in Europe, Asia, or the Middle East. A third possibility sits in the middle. The SEC's rules spur Congress to step up. Realizing the patchwork of regulation is stifling both innovation and fair markets, lawmakers pass comprehensive crypto legislation, like the Lummis-Gillibrand Payment Stablecoin Act, which provides even clearer, tech-specific guidelines. In this scenario, the U.S. regulatory apparatus finally adapts to the complexities of blockchain, blending investor protection with innovation. Which of these futures will play out? It depends on how regulators, industry leaders, and, yes, even ordinary users respond to this moment. For startups and developers, the practical stakes are enormous. Every new token project has to dissect the SEC's three prongs. First, how was the token marketed at launch? If you make any suggestion that buyers could get rich from your token, the SEC will be watching. Even for so-called utility tokens, it's not enough to simply offer a useful feature. If users are led to believe the value will rise based on your hard work, you're in the danger zone. Second, how does the token function in practice? The SEC is looking not just at promises, but at actual usage. Tokens that merely sit in wallets as speculative chips get extra scrutiny. But if tokens provide genuine access to a decentralized platform or serve operational needs like gas fees, they have a much better shot at avoiding securities status. Third, how much influence do founders or core teams retain? Decentralization is out of the buzzword stage and now in the legal crosshairs. If a handful of insiders can change the rules of a protocol or make unilateral decisions about upgrades or funds, the SEC may view that as a common enterprise, the central hallmark of a security. This means founders and DAOs need to document their paths to decentralization. Transparent governance, routine external audits, and real community control aren't just good PR, they're legal shields. For investors, the benefit is a double-edged sword. On one hand, the wild volatility and outright scams that have plagued crypto for years may become less common under stricter rules. On the other, some of the meteoric gains tied to early-stage, barely legal projects might be gone for good. Veteran analyst Marcus Jong puts it bluntly, with this guidance, the riskiest tokens are dead on arrival, but so are some of the best opportunities for outsized returns. Yet, there are winning strategies for both sides. For builders, focus on genuine utility. Document everything. Launch with decentralized governance from the start, and never make profit promises you can't keep. For investors, favor projects that openly comply with SEC guidance, or that are distinctly decentralized. Stablecoins and Layer 1 utility tokens, those powering key networks, may be the safest bets. There's a bigger lesson here, though, that stretches beyond lawyers' offices and courtrooms. Crypto's original ethos was about decentralization, transparency, and giving power back to users. The SEC's 2025 guidance, in a way, forces the industry to live up to those ideals, or risk exclusion from the world's largest economy. But don't be fooled, this isn't the end of regulatory battles. The SEC's new crypto task force, led by Commissioner Hester Pierce, is actively seeking public input, and its first report is yet to be released. Challenges remain. Court fights over what counts as sufficient decentralization or how to meaningfully distinguish a utility token from a disguised security are sure to continue. In fact, legal ambiguity isn't going away anytime soon. One positive sign, the SEC's own language has become more nuanced. For the first time, SEC staff have acknowledged that some staking activities may not constitute securities offerings, opening the door for future DeFi products to operate within U.S. borders, if they're structured with care. And there's a secret fact not widely discussed. Although the guidance is strict, it's also deliberately incomplete. The SEC is leaving room for legislative fixes and industry feedback. That means if the broader crypto community speaks up, through public comment periods, lobbying, or thoughtful engagement, it can still shape the rules before they're set in stone. So where does this leave us? The answer to the big question, will the SEC's crackdown foster trust or strangle innovation, remains. It's up to us. Order may come at the cost of rapid experimentation, yes, but innovation isn't dead. It's simply moving into a new phase, one where transparency and decentralization are not just ideals, but legal imperatives. For viewers, the next step is clear. Stay informed. Whether you're a developer, investor, or just curious about the future of finance, now is not the time to tune out. Engage with the process, follow regulatory news, and support projects that value real decentralization and responsible innovation. If you enjoyed this deep dive, make sure to like and subscribe. Got questions about your favorite token, or want us to